Do you know why the rich get richer? This is simply because they've mastered the ways to make money with debt. Taking up a loan, a simple personal loan, can help exponentially multiply your returns and assets. This entails borrowing money to increase your capital and create the cash flow for future investments. In recent years, the word debt has gotten a negative connotation, but the truth is that not all debt is bad. In fact, some kinds of debt might really be beneficial to you. Taking a good debt is one of the simplest ways to start leveraging the potential of your money and generating more passive income that will eventually help you build real wealth. Leveraging debt means increasing your chance of expanding your wealth with borrowed funds. While the opportunity is available for all, nevertheless, you need to carefully equip yourself with the right knowledge before embarking on this. Here are some excellent ways on how to leverage debt to make money. Eliminate all bad debts and get good debt. The very first step is to improve your credit score. Since the principle is to take on good debt at a low interest rate and invest it into something that gives you a higher ROI, let's say a higher interest rate, then you pay back the loan and enjoy the profit. However, if you are still heavily indebted and paying exorbitant interest rates, things could get really complicated for you. The reason it's advisable you engage every resource and tool at your disposal to optimize your income, reduce your expenses, and perhaps enhance your credit rating before thinking of managing money that is not yours. Of course, a loan or debt is money that doesn't belong to you. You're only a temporary custodian. In addition to this, you need to be extremely cautious, especially if you're not comfortable with taking risks. You should also be extremely careful how you invest the money. Keep the risk as low as possible, which is obviously important. Remember, it's not your money. Taking up any debt, even the fairly low-cost debt, long payback times kind of debt, or any whatsoever, is always a risk. If you're already in multiple debts, or if what you owe exceeds your assets or savings, without a prior proper assignment conducted, you will end up in deeper losses than you could ever imagine. Always bear in mind that the goal of this entire process is to come out of it with more money than you started with. This entire endeavor could be fruitless if you take on a debt that chokes your cash flow or results in severe financial difficulty, meaning it's not worth the effort. So don't borrow more money than you can afford to pay back, and do invest it wisely, keeping in mind that it isn't actually yours. Purchase or start a business. Once you've reduced your multiple loans and improved your credit score, it's now time to maximize some good debt. We refer to this as gearing. Do you need money to start a great company idea? Or perhaps you spotted a franchise in a prime location and want to buy it? With a personal loan, you can venture into this. Nevertheless, certain businesses require a little capital to start. People who desire to start, buy, or expand a business can get loans from banks, financial institutions, or government agencies. Even though the application procedure for these loans can be time-consuming and involve certain qualification steps, if you do your research and create a strong business plan, you can be approved for a loan at a very low interest rate. Create your company with the loan, grow, and pay off the loan. In a few years, you'll not only be building your generational wealth, but you'll also be an example to others. Leverage debt in stocks and index funds. Investing in the stock market and index funds is one of the safest ways to build wealth. You can decide to invest in both or either of the two. While some prefer to invest in stocks, others prefer leveraging index funds. When you purchase shares of stock in a certain company, you become a takeholder in the corporation. That implies that depending on how well the business operates, you earn a share of the profits or losses. Whereas purchasing an index fund entails purchasing a collection of stocks that are intended to follow a specific index. Purchasing shares of an index fund means you indirectly own stock in dozens, hundreds, or even thousands of distinct companies. When you purchase stock in a company, you are betting on the success of the underlying business and the consequent increase in share value. When you invest in an index fund, you are hoping that the entire market sector the index tracks will perform well and increase in value, hence increasing the value of your index fund holdings. That essentially sums up the distinction between stocks and index funds. Investing in stocks provides you the possibility of making huge money over a long period. Compared to index funds, it is less risky. Investing in index funds could sometimes be a dangerous endeavor. Nevertheless, it enables investors to diversify their stock portfolios. Additionally, it enables those with less knowledge to pick up trading without making a big financial commitment. Margin investing. This enables you to purchase more shares than you can afford. If everything goes as planned, you could make a lot of money, but if things don't, you could lose it all. According to how it works, if you have $20,000 in your brokerage account, you can open a margin account based on your initial investment, and you are only allowed to deposit up to 50% of the stock's cost using a margin account. Therefore, should you desire to purchase stock worth $40,000 but only have $20,000, the brokerage will lend you an additional $20,000 to complete the transaction. If the stock price increases, you can pay back the debt and still have your profit. On the other hand, the stock could decrease in value, and when it declines beyond a stipulated value, your brokers would issue a margin call, which might oblige you to sell off all your assets or deposit more funds into your margin account. Leveraged ETFs. The rich have the opportunity to exponentially multiply their earnings by going long or short on a specific index by using leveraged exchange-traded funds, ETFs. They employ fund providers that provide leveraged ETFs, which allow investors to multiply returns or losses as much as 200% to 300%. With possibilities such as these, the rich invest in specific indexes, bonds, commodities, or sectors. You can also benefit from this system. Leveraged ETFs are alluring solutions for anyone to generate exceptional profit potential. It simply means using financial derivatives and debt to amplify the returns of an underlying index. But there is a challenge. In the same way leveraged ETFs generate enormous returns on investment, they also generate enormous potential losses. Leveraged ETFs can amplify losses by wiping out your entire investment in a matter of days, unless you are an expert trader in and out of these funds. Make your debt work for you through real estate investing. One of the qualities that differentiate the poor from the rich is their ability to rightly invest their debt and make much money from it. The rich understand how to use debt to purchase properties that can be sold at a greater price when the value of the property increases, or that can be rented out to create monthly or annual income. Leveraging debt is taking out a loan to finance real estate. When the value rises, your return on investment rises, and if the home value declines, you tend to lose the return on your investment as well. It's crucial to do your research and pick a home with equity potential. There are also buy and hold investment properties available. The world of real estate investing is vast. There are many ways to invest, including house flipping, property wholesale, and many others. But the buy and hold investing, more popularly known as owning rental properties, is one of the finest ways to generate monthly cash flow and increase wealth at the same time. To be honest, the typical returns on properties range from 9% to 17%. Some are lower, while others are far higher, whereas savings accounts and 401ks may not provide you with a monthly paycheck. Real estate can. Currency trading. By buying currency when it is weak and selling it when it stabilizes in the foreign exchange market, currency trading, also known as Forex, enables people to purchase and sell currencies for profit. Although money trading is not without controversy, it is easy and simple for fast money making and offers quick liquidation alternatives, which is perfect for individuals looking to leverage debt. Currency exchange takes place in the Forex market, a platform that facilitates international trade. For instance, the US dollar is not accepted in China. To conduct business in China, you must purchase Chinese yen. A Forex market is a place where any individual business or institution can go to buy foreign currency. These currencies' exchange rates fluctuate due to several reasons, but you will make a lot of money in this market if you are skilled at analysis and can predict which currency will rise or fall. To engage in this, you must choose the most appropriate currency to buy and sell. If the price of the currency is anticipated to rise, buyers can also opt to purchase earlier to boost their chances of making money by selling their currency immediately after purchasing it. Each of these investment opportunities depends on borrowing money from a lender, so be cautious when selecting a company and ensure that it provides you with reasonable terms and conditions for repayment. For beginners, trading in stocks takes a while before beginning to generate reasonable profit. Thus, pick a flexible financial institution that gives room for growth. As much as there are possibilities of growing your wealth and debt, there are two borrowing rules you must follow, which are: first, avoid borrowing for consumption. Instead, the goal is to use debt as leverage to improve your overall financial situation. Lastly, steer clear of predatory lenders. Thanks for watching.